if I could attribute some of the recent volatility to anything, I'd say, while there are individual events that may have triggered it, I think the main reason for this kind of thing happening is that with each new wave, each new bull market, there are so many new investors coming into the space who are excited about it but don't know a lot about it as well. And they have a tendency to be kind of panicky, right? Those of us who've been through, say, 4 or 5 boom and bust cycles like this now are starting to realize that the industry's not going away, and every time it comes back a bit stronger than it was before. So the all-time highs are higher than the previous ones, and the all-time lows are higher as well. They never go back down to the same state. You're never going to find Bitcoin under $1,000 again.
Information provided by Wall Street Petting Zoo is for educational purposes only and not intended to be financial advice. Please consult with a licensed financial advisor before making any financial decisions.
Cryptocrash.
So Wednesday morning, the entire cryptocurrency market suffered a flash crash, with Bitcoin down 30% and Ethereum down 45% at the low of the day. Was it a buying opportunity or the beginning of the end for crypto? Hello and welcome back to a special cryptocurrency episode of the Wall Street Petting Zoo. I'm Christopher Smith.
And I'm Robert Coburn. The cryptocurrency world moves fast, Chris. As you said, Bitcoin and Ethereum dropped 30% and 45% Wednesday morning, and many altcoins, meaning cryptocurrencies other than Bitcoin and Ethereum, suffered drops of 50% or more. But by midday, they were back up, and with Ethereum rallying more than 50% off the lows. The next few days were a wild roller coaster ride with intraday price swings of 35% or more. I think a few fortunes have been made and lost in the past few days. This week, we'll dig into the reasons for the crash. We'll also nerd out a bit on cryptocurrency technologies and make some predictions about where the market might go from here.
There have been lots of interesting developments in the cryptocurrency world lately. Bitcoin has gotten a lot of negative publicity because of its environmental cost. By one estimate, Bitcoin uses 120 terawatt hours per year. That means that if Bitcoin were a country, it would be the 28th largest energy consumer above Norway and Argentina, and the 7th largest carbon emitter. And this to process just 270,000 transactions per day, which is a pretty minuscule number of transactions. For comparison, Visa processes 150 million transactions per day, which is 550 times as many transactions as the Bitcoin network is processing. To put this into perspective, the energy used by a single Bitcoin transaction could power your home for 24 days. And unfortunately, Bitcoin doesn't become more efficient over time. Quite the opposite, in fact. It's deliberately designed to become less efficient over time in order to make it harder for hackers to attack. Financial Times published a projection the other day that Bitcoin is such a gross polluter that it could single-handedly foil the Paris Agreement on climate change's goal to keep global warming under 2 degrees over the next few decades.
The environmental cost of Bitcoin has led even some of its biggest fans to turn against it. Until recently, Elon Musk, the CEO of Tesla, was a big Bitcoin booster and has been allowing customers to buy cars with Bitcoin. But a couple weeks ago, Musk announced on Twitter that Tesla would no longer accept Bitcoin and would sell the Bitcoin it had on the books. He specifically cited Bitcoin's environmental cost as the reason, although another reason may be that because of the intricacies of corporate accounting, Tesla can't book Bitcoin as profit. So Bitcoin purchases left a big hole in Tesla's balance sheet on their last earnings report. Whatever the reasons for the announcement, it caused a big price drop and a lot of anger against Elon Musk from Bitcoin investors who got burnt by the tweet.
As an alternative to Bitcoin, Musk has been boosting Dogecoin. Now, Dogecoin was created as a joke based on a meme about a dog, and Elon Musk's boosterism of Dogecoin has been a bit of a clown show. He tweeted that he has been working with the Dogecoin developers to make improvements to Dogecoin, and then the developers came back and said that they had never talked to Elon Musk. So a bit messy in terms of the Twitter back and forth. But Doge is more efficient than Bitcoin. Elon Musk is correct about that because it uses a faster algorithm than Bitcoin does. However, because it uses a faster algorithm, it's also less secure against hacking than Bitcoin. And like Bitcoin, it's still what's called a proof of work coin. We'll get into that a little bit later when we interview our special guest today. Proof of work is less efficient than a lot of other coins that are proof of stake. And these are just two different ways of making sure that transactions are secure. Most of the crypto world right now is moving toward proof of stake because it's so much more efficient. So all of that means that Dogecoin is not the best choice necessarily to solve the environmental problem with Bitcoin. It's also an odd choice for an investment because new Dogecoins are created very rapidly. The rewards for mining Dogecoin are extremely high. Which means that the value of your coins is constantly being diluted by the creation of lots of new coins. And so most crypto investors seek out coins with a much more limited supply than Dogecoin has.
While Dogecoin has been trading like a meme, going up on the marijuana holiday 420 and topping out at the sex number price of 69 cents, another coin has been massively outperforming Bitcoin all year. I am speaking of Ethereum, the second biggest crypto coin by market cap. Like Bitcoin, Ethereum is a proof of work coin that's very damaging to the environment. But unlike Bitcoin, the Ethereum developers are actively working to convert the coin to a proof of stake system that would make it much more environmentally friendly. The conversion is supposed to happen sometime this year, and traders have been enthusiastically buying Ethereum in anticipation. Ethereum is getting close to half of Bitcoin's market cap, and I wouldn't be surprised to see it surpass Bitcoin by the end of 2021. Other proof-of-stake coins like Nano and Cardano have been outperforming Bitcoin as well.
So Bitcoin had already been struggling a little bit due to bad press from Elon Musk. And then a couple weeks ago, it got some more bad press when a court-ordered Tether, the company behind a cryptocurrency of the same name, Tethercoin, to disclose information about its finances. About 80% of Bitcoin purchases are made with Tethercoin. Supposedly, every Tethercoin is backed by $1, so you can turn in your Tethercoin and get back $1. But Tether is somewhat shady. It's located in a tax haven. It does not normally disclose its finances, and so recently a court ordered Tether to disclose its finances. And Tether revealed that it only has enough cash to cover about 3% of the Tether coins in circulation. The rest are backed by commercial paper, which are like very short-term corporate bonds. They're kind of corporate IOUs. And so the problem with this is that we don't know whether that commercial paper is actually any good because Tether hasn't disclosed any details about those investments, who those corporate IOUs are from, and the creditworthiness of those companies and those bonds. So if the companies that issued that commercial paper were to default, Tether might not be able to redeem all those Tether coins for US dollars, and this created a little bit of uncertainty, I think, about Bitcoin.
And by the way, because Tether is an unregulated currency, they're able to do irresponsible stuff like offer insane amounts of leverage on Tether coins. If I have one Tether coin, I can borrow 125 more with just then one coin as collateral. That kind of leverage makes crypto markets extremely vulnerable to a quick collapse, because if the price goes down, leveraged traders will get margin calls and will be forced to sell, which brings us to this week's Cryptocrash.
Yeah, Tuesday night, the Chinese government announced that it was banning all financial institutions in the country from doing any business in cryptocurrency. Now, mind you, this is only the latest in a long line of recent Chinese government actions against crypto. In 2017, the Chinese government shut down all crypto exchanges located in China. And then 2 years later, in 2019, they banned all foreign exchanges. So this new announcement honestly doesn't change that much in terms of the crypto market in China, but it was enough to cause some selling. And then some of those highly leveraged traders got margin calls and were forced by their lenders to sell in order to cover their loans. And most cryptocurrencies plummeted by about 45% by Wednesday morning. But they recovered pretty quickly by midday. Once all those leveraged traders were cleared out, there was a lot of buying, and the coins rallied up to 50% off the lows.
For a minute there, it seemed like everything would be fine. But then the US government threw some gas on the fire on Thursday with the announcement that the IRS is going to crack down on the use of crypto for tax evasion. The Chinese government piled on again on Friday with the announcement that they're going to crack down on Bitcoin miners, and they want citizens to report any mining activity they know about. Suffice to say, the sell-off continued. Today, on Sunday, the price of Ethereum dipped below Wednesday's lows. In all, the collective market cap of cryptocurrencies has been cut in half from about 2 trillion to about 1 trillion.
All of which raises the question of where crypto goes from here.
I personally have about 15% of my portfolio in crypto. Bitcoin, Ethereum, Litecoin, and Dogecoin. Unlike previous investment blowups in the past, such as, the tulip bulb investment bubble in the 1600s and the South Sea Company in the 1700s, I feel that cryptocurrency is distinguishing itself to inevitably having a functional use in society.
So we disagree a little bit on this, Robert, because I think tulip bulbs had a functional use in society as well. We still use tulip bulbs today. They just weren't useful enough to warrant the massive prices that speculators were paying for them at the peak of that bubble in the 1600s. And I kind of feel the same about crypto. I agree with you that it has some usefulness, but I worry that a $2 trillion market cap is just a huge valuation for what is essentially an anonymous and decentralized wire transfer service, kind of like a Citizens Western Union. That's just a huge valuation for that kind of technology. And I also worry a lot about the environmental impact and the way that crypto facilitates criminal activity.
Well, we each have our opinions, Chris, but neither of us are experts. So tonight we've brought on a special guest. Please welcome to the show Carl Youngblood, a senior blockchain specialist with Amazon Web Services, or AWS, and the founder of his own consulting company, Blockchain Consulting LLC. Welcome to the show, Carl. We're so excited to have you.
Hi, Robert and Chris. It's great to be with you guys. One thing I should say is that the opinions that I share here will be my own and don't necessarily reflect my employer at all, and also don't constitute any form of investment advice.
Absolutely.
Yeah, Carl, why don't you start by telling our listeners very briefly what is a cryptocurrency and what's the difference between a proof of work coin and a proof of stake coin?
So a cryptocurrency is basically a decentralized ledger that keeps track of balances that are stored across many different accounts, each of which is controlled by the owner of the private key that corresponds with a particular account. So funds can only be transferred from one account to another if the owner of the private key signs a transaction proving that they had the authority to make that transfer.
So if I can just boil this down a little bit, by comparing it to Visa, let's say, if I do a transaction through Visa, the ledger that is recording that transaction is on Visa's servers. It's controlled by Visa. It's a centralized ledger. And what you're saying is a cryptocurrency has a decentralized ledger where it's distributed on lots of different people's computers. Is that fair?
Exactly. And to explain the difference between proof of work and proof of stake, proof of work was the first consensus mechanism invented by the creator of the first cryptocurrency, which was Bitcoin. And what it essentially does is it requires the nodes on the distributed ledger, the servers essentially that are keeping track of the ledger and propagating transactions as they are submitted to the system. It requires these nodes to perform some kind of computation before they can earn the right to produce the next page in the ledger, the next block in the blockchain, if you will. So the nodes that can perform a very computationally intensive algorithm that just requires them to search through essentially a vast cryptographic haystack to find a needle. The ones that have the most computational capacity are the ones that are more likely to find that solution to this computational problem, and thereby earn the right to produce the next block. And after producing the next block, they're rewarded with a certain amount of tokens. In this case, in the case of Bitcoin, they're rewarded with Bitcoin for producing that block. So that's in brief, that's what a proof of work does. Now, proof of stake is a kind of innovation that appeared in subsequent blockchains. Most every new blockchain that comes out is using proof of stake as its consensus mechanism because it's generally agreed that it's more effective, less susceptible to certain types of security issues than proof of work. But proof of stake just grants the right to produce new blocks in a blockchain proportionally to the amount of tokens that each account in the blockchain holds. So, for example, the accounts that have more value, a higher balance, more tokens, would be called upon more frequently, proportional to the tokens that they own, to produce the next block and thereby earn the reward for that block. What's a little weird about it is that what it essentially means is that the accounts that already have the most funds are the ones who have the right to earn more funds than the others. So it sounds a little odd because it's like the rich are getting richer in that kind of a scenario. But on the other hand, the argument is that the ones who hold the most tokens are the ones who stand the most to lose if they behave in a fraudulent manner that would place the overall token value at risk, right? So the idea is that they would have the most incentive to behave appropriately and not do anything untoward or anything against the rules to try to undermine the value of the token. And the other interesting thing about proof of stake is that because we're calling upon many different accounts to produce blocks, there's an argument that can be made that the consensus mechanism is more robust and that it's distributed more broadly across more participants in the network. So this is kind of how proof of stake works in general, but it's one of the big things is that it doesn't have this really computationally intensive problem that you have to solve in order to produce another block, which means that it doesn't use any excess energy. It doesn't use any more energy than any other protocol out there on the internet like HTTP or any of the common internet protocols. And so it's seen as both better in that the risk of an attack against a proof of stake network is directly proportional to the value in that network, whereas in Bitcoin and proof of work networks, there's often the cost of an attack is much lower than the potential value that could be extracted from the network for making that attack. So there's that weakness in proof of work as well as the weakness of just consuming an insane amount of energy, which many believe is not really an inherently necessary thing to do, right?
And then how does making people solve extremely difficult math problems, how does that secure the transactions? I mean, if I have a lot of computational power, wouldn't that still let me control the next block? How does that fix things and make them secure?
Well, so essentially what that does is that if you ever wanted to forge history, if you will, if you wanted to recreate a different set of transactions in the past and claim that those were the actual events that occurred and that somehow someone sent you a lot more funds than you actually have, you would have to solve that computational problem for every single block that has gone by. So the more time that goes by in the network, the harder and harder it becomes to reproduce that amount of computation just in order to forge history, if you will. And not only that, but you have to then share that alternate view of history with all the other nodes on the network and persuade them that they should adopt this this alternate view of history. So it becomes computationally infeasible to do that for any significant amount of time.
I see. So talk to us about the usefulness of cryptocurrencies as a technology. What does crypto bring to the table that traditional currencies don't?
So one of the main use cases for the first cryptocurrency is just the ability to transfer value from one party to another across jurisdictional boundaries, across borders in near real time. So if you were to compare that to the best alternative nowadays, I would say probably a wire transfer is one of the fastest ways of sending money to another individual out there. If we're just talking person-to-person transfers, right? Let's just look at that use case of the person-to-person wire transfer. I call my bank, I send some funds, or I go online and I ask for a wire to be sent, and I'll get a call from my bank a few hours later confirming that I indeed wanted this to happen and that it's not some other person doing it against my will. And then if I'm lucky, it will go out the same day, and later on in the afternoon, it will be seen on the other side. Maybe it'll take until the next day, depending on the cutoffs that they have. So if you compare a Bitcoin transfer with a wire transfer, I actually feel that the user experience is better on Bitcoin. And then, of course, newer blockchains are a little bit better than that, and they go a little faster than Bitcoin usually. And that's one use case, right? That's the person-to-person transfer of value. But another really critical use case that is a part of pretty much every what I call second-generation blockchains, which Ethereum is the most noteworthy of those. They added the notion of that the transactions that are being submitted to the blockchain are not just debits and credits like Bitcoin does, but they're actually opcodes for a computer CPU, essentially. So they are now arbitrary software commands that can be used to encode any type of business logic that you want to encode.
Is this what smart contracts means?
Exactly. I was going to say this is typically called smart contracts, and what this means is that I can create more complex types of protocols or operations or rules that I want to be followed autonomously in response to other events that occur on the blockchain without me having to do anything. I can create services that other people can take advantage of and use, and really the sky's the limit. And it's in a similar way to the way the internet allowed anyone to connect a computer to this global network and build services that anyone could use. Blockchain enables anyone to build services that involve funds in some way or another. And the other cool thing that blockchains have that the internet did not is that the infrastructure is inherently incentivized. So whereas the internet didn't include a monetization layer built into the protocols themselves, blockchains do. So in blockchains, all of the operations that are happening are being paid for already as a part of just using the blockchain. Whereas on the internet, the companies that started to make money on the internet needed to extract value at higher layers of abstraction. So there was no inherent way to be paid for receiving a packet of data via HTTP, for example, or via the World Wide Web. So instead, Google and Facebook and other large players decided to create things like advertisements or other ways, social media programs, other ways of monetizing the infrastructure that they were building out.
So when you're talking about things being incentivized, are you saying that like Facebook or some company that's offering a service could directly charge for access to that service and they could get compensated via, say, Ethereum for every packet of data that I download from their service? Is that kind of what we're talking about?
Exactly. Yeah. So basically, right now, like Ethereum, they are enforcing really low level kind of services, and the cost of a transaction is relatively high. But you can imagine that other layers that any application would need to run, like storing data or like sending packets of data back and forth, or storing data in a database, or even performing computation on data, all of those kind of services that you currently receive from a cloud provider like AWS or Google Cloud or others, could be incentivized with crypto. So you could have protocol layers where the providers of these services are all a part of a peer-to-peer network, and you're kind of renting space from them and renting other services from them, and they're charging you. And there's a competitive marketplace where you rent these services from the various providers that are out there in this peer-to-peer network, and they're all paid and incentivized to provide these services with crypto. And if they're not, if they're functioning in a fraudulent way, they get slashed and they lose some of their funds, and various things that can be done to enforce the harmonious operation of a peer-to-peer service that no one central provider is providing.
Carl, there are so many cryptocurrencies out there now, and it seems it's time to start being selective about which ones to buy, because there will probably be there will only be a few winners and a lot of losers. Do you have any opinions on which coins might ultimately win?
Well, so the space is getting more sophisticated in the sense that it's now possible to hold on to your cryptocurrency, your tokens, whatever they happen to be, and not actually sell them, but farm them out or use them as collateral for other services that are providing utility and value to people who are using them to, say, swap tokens from one to another, or borrowing funds, lending funds to others. These kind of basic financial services that are already available in the traditional financial space are now being developed on Ethereum and other second generation blockchains. And it's possible to hold on to your crypto and still be earning returns on that crypto. And so the idea of merely buying a token that's not valued very highly right now, and then holding on to it for a long time, and then hopefully selling it at a profit, is no longer the only game in town in terms of investment, right? So that just speaking about investing strategies. But if we're talking about the tokens themselves and what they represent and what they're the types of ecosystems that are being built based on them, I would say that right now what we're seeing the most proliferation of is a lot of tokens related to decentralized finance. And I think that while decentralized finance is providing actual utility, it's actually reproducing many of the same functionality that we see in the traditional financial markets, but in a more decentralized, accessible way. I would say that this is only one small slice. Like the financial services industry is not the whole. It is not responsible for anywhere near the entire GDP, say, of the country, right? There's lots of other industries out there that are doing a lot of useful. Creating a lot of useful products and services. In the same way, there are many other protocols that will be needed to reproduce the current functionality that is available through centralized services in a more decentralized way. And those things are still in the very early days of their maturity. So there are protocols like Filecoin for incentivized distributed storage. There are protocols like some related, like BlueZell, related to distributed databases. There are others related to computation, and all of those are barely off the ground. And so it's kind of hard to even predict what the winners are going to be there. But then already we see a proliferation of DeFi tokens and things like that. And well, I think there's utility in the DeFi space. I think there's a lot of speculation going on that is in excess of probably what the overall mature size of that space will be.
Are you seeing the innovation kind of concentrated in one area or one coin, or is it pretty broadly distributed and really hard to tell sort of which coins are the leaders?
Well, I would say that by far the Ethereum ecosystem is where most of the innovation and activity is happening. My back of the napkin estimate of like how much bigger the Ethereum ecosystem is compared to other Turing complete blockchains, it would be like at least 10 times larger than all the others that I can think of, possibly even more like 100 times. I don't know the exact order of magnitude or the exact difference, but in terms of total value locked on Ethereum-based DeFi projects versus other blockchains, I would say it's a huge difference there.
Well, I know that there's this merge coming where they're going to take Ethereum proof of stake. If I were to invest in one of the projects that's built on top of Ethereum, like Polygon, which is one of the leading what's called layer 2 Ethereum projects, is that basically going to become obsolete once they do the merge, or is there still going to be additional utility that Polygon brings on top of the sort of revised Ethereum base chain?
I think there will still be a lot of utility from Polygon. All that proof of stake will do is it will mean that the way that we achieve consensus in the Ethereum blockchain will no longer rely on that excess energy, that computationally intensive algorithm. But the transaction rates will still be similar, which means that the congestion problems that we're experiencing will still be there. And so layer 1 is already full and transactions are horrendously costly right now. So Polygon, or Matic as it used to be called, is really helping there by doing what we call roll-ups, which allows you or side chains, depending on which particular algorithm you're looking at, but allows you to basically stuff a bunch of transactions into an operation that occurs out of band, outside of the core blockchain, and then a proof that the entire batch of transactions was executed properly is then anchored to the original blockchain. So that can greatly improve the overall throughput of the network and make it more like financially reasonable to execute transactions. They can cost like pennies instead of hundreds of dollars, So definitely projects like Polygon are going to be really important even after proof of stake is adopted.
So I've looked into some of the stuff that you're talking about, the liquidity pools with Polygon and other coins. It seems like when you're going several layers deep into this crypto thing, it gets very complicated very quickly. And so I'm wondering if, layer 1 is full and you're still going to need layer 2 and all these side chains, does it get really too complicated for kind of the regular people to use? And what is the solution for sort of ease of use?
I mean, I definitely agree that it's not for the faint-hearted, and if you'll pardon the stereotype, it doesn't pass the grandma test. I kind of think of it like, if you remember back in the early days of the internet, before Windows 95 came out, in order to connect to the internet, you had to install this program called Trumpet WinSock onto your Windows 3.1 machine, and you had to tell it how to talk to your modem and configure your baud rate. You had to set up what your DNS IP address was, and all these things that you had no clue what they were, but you had to plug in the right magic numbers to make it all configured properly. Most of that nobody even has to worry about anymore. That's all just sort of happens when you first receive your router from your internet provider. You just plug it in and it starts working pretty much. So things have gotten a lot easier. But that wasn't always the case. And I think we're kind of in those early days where some things will get easier. But on the other hand, there is this thing about blockchains which requires you to manage your own keys. And that is a really thorny problem, the problem of key custody and how to make it easy to use while still making keys safe and secure and preventing people from losing all their funds. I think all of us who've been in this industry for a while have had some story about having lost lots of funds. I lost $15 million worth of Bitcoins early on in my...
Oh my God, Carl.
Yeah. I laugh about it now. At the time, it was only... at the time that I identified that I had accidentally erased my wallet, it would have only cost me $2,000 to replace those coins. But my wife said, we were going to go on vacation with that money, and I just set it aside. And, several years later, it's now worth far more than that. But, we've all had weird stories like that. And this is a really challenging problem that I think is difficult to get right from a user experience perspective. And some of the strategies we're seeing are things like, relying on friends and family to help you recover your keys by having like each one of them be able to provide one secret that when combined would allow you to recover, or just things like trust, like creating an agent that is trusted to authorize transactions that don't exceed a certain value. I mean, but it's a challenging issue, and it's something that's going to take a long time to get right. So I think things will get easier, but they're still always going to be a little bit complicated. And I'm thinking kind of that this may be a generational thing, like in the same way that our kids are very comfortable with using mobile apps and all the kinds of things they do on them. Maybe managing your wallet from a cryptocurrency perspective will become like just part of the literacy of the digital literacy of that generation,
So, Carl, you see cryptocurrencies as just the beginning of what blockchain can do to revolutionize the world, and that's a powerful vision. But as a cryptocurrency investor, buying Bitcoin or Ethereum doesn't necessarily help bring about any of those other changes. Are there any ways to invest in any of those other blockchain technologies yet?
Yeah, well, I would say that I do think that just promoting the general activity in the space is probably in an indirect way helping to inspire the future builders who are, trying to build these interesting futures that we're talking about. There's one called Proof of Humanity that I think is kind of interesting, that is a universal basic income project that is trying to create a protocol by which individuals could verify that a person is actually a real person, prove their personhood, and then become a part of a pool that will eventually pay out an income to all of the pool participants, I guess. So these are just a few interesting projects out there. There's so many, but so I wouldn't pick any of these in particular that I mentioned as somehow more deserving of merit. But there, if you study the space, there definitely are some exciting things going on, and I'm excited for the long term.
I'm curious, when you're talking about some of these future applications of blockchain and the projects that you mentioned, are those things built on the Ethereum ecosystem? And if so, does buying Ethereum kind of constitute a kind of indirect way of being long on some of those other projects?
I would say it does. I think that, more than any other cryptocurrency out there right now, I feel like Ethereum is the most blue chip of them all. I'm even sort of, if I were to identify my own preferences, I would say I'm heavier Ethereum than Bitcoin because of its greater utility there and because of how much more activity is going on in that space. So I do feel like merely buying Ethereum is ultimately an investment in the entire ecosystem and the activity that's happening there, including some of these other projects that we're talking about, because they're all kind of integrating with and making sure they're compatible with that ecosystem.
Awesome. Well, thank you so much, Carl, for coming on with us. Love chatting with you.
Okay.
Well, that's our episode for today. Thanks so much for listening. And if you'd like to support the Wall Street Petting Zoo podcast, please give us a like, share, or comment on your favorite social media app. You can find the Wall Street Petting Zoo podcast on Podbean, iTunes, Stitcher, Spotify, or your favorite podcasting app. If you liked today's podcast episode or found anything in it useful, please consider giving us a 5-star review on iTunes. It really helps a lot, and we really appreciate your support. Please also consider following Carl Youngblood on Twitter. His handle is @CAYBlood. Thanks again to Carl for coming on the podcast, and thank you, dear podcast listener, for your loyalty and support.